Good Thursday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
All right.
I'm going to share my screen.
What's going on in the pre-market day after the Fed meeting?
So we'll take a look at the pre-market today. I also wanted to take a look at what they call the Fed dot chart. We'll kind of go through it quickly just to get a sense of, how to read it, what they're saying, what they're projecting. I think it's a good exercise. You can get a lot out of it. So I think we'll do that today. In addition to that, if you guys have questions, put those questions on the live chat. Will, you're watching them, you'll read it back to me. If anybody wants to come on a show, ask the question live. We also put out a link to Zoom. Click on that link, go over to Zoom. There's a button, raise your hand, click on that. You don't have to turn on your video camera. Everybody will be able to hear you. So those are two ways to ask questions. And, and if questions come in, will stop me, let me know. But let's get started on a pre-market report. I did go to the Federal Reserve FOMC notes from yesterday, so we'll start on that, and you'll stop me if questions come in.
Sounds good, D.
All right, so this is the pre-market report. These are stocks trading in pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. We see 75 stocks made the percentage gainers list, 21 on the decliners. So right now, from this perspective, looks like we're lining up for a bullish bias at the open. I'm going to filter out this list to look at just S&P 500 stocks. That way we filter out any low cap stocks, ETFs, leverage products, closed-end funds, units, rights, all that stuff. We'll take it out just to see what's going on in S&P 500 companies. And to do that, I'm using this filter above. In ETF, I have a list of ETFs. I'm going to select SPY, which is the S&P 500 ETF. And when I do that, the filter will narrow the list down below to stocks that are holdings in SPY, which is the S&P 500 ETF. And here we see 13 stocks made our percentage gainers list. So far, none on our decliners list. So right now, we're looking like slightly bullish at the open. Yesterday, we did sell off. It was pretty volatile during the day. We're up, down, then back up, then finally sold off. And it looks like, most of that came from, not a surprise, the 75 basis points, but the markets determined that the Fed is determined to get that inflation back down to 2% and make sure that it's holding there before they move interest rates, back to where they think is neutral. So let's take a look. Let's take a look at that Fed dot plot, if there are no questions, and see what they're thinking, right? And it's important, and I think it's a good exercise for a lot of reasons, especially if you're trading, analyzing, or doing research. And I like to go and just read other research reports because it shows you kind of how they organize data, how they track their data, how they look at, their projections, and then they take their projections and compare it to the actual outcomes, track their errors, make adjustments. And the Federal Reserve has like something like 400 or hundreds of people, PhDs, looking at all these financial models. So it's very interesting just even to read, and it gives you even ideas. If you get into the habit of reading, it gives you ideas even how to create your own models, track your own data. So let's just kind of start looking at their plot. So this is the FOMC economic projections. And so yesterday they raised interest rates, they made a decision, then they come out with these releases. So you can see here from yesterday, September 21st, they came out with their economic projections, and they create these tables here. And I do want to I highlighted this because right now, if you're watching the news or you're reading, and there are a lot of people coming out and saying the Fed's going too far, they're gonna hurt this and that, and it's usually because of the stock market, right? Stock market falls, and then you got a flood of people coming out. Fed's going too far, the market's falling. They got to stop with the interest rates because they're feeling the pain in their portfolio, in their asset prices. But that's not
people talk their books, right?
They talk their books, and then they're going to make all these, claims why they're going too far and so forth. But the Fed doesn't think that way, right? They don't look at the stock market as their benchmark. And
they're not supposed to, that's for sure.
They're not supposed to, right? And that's why I highlighted this. This is their statutory mandate to provide maximum employment and price stability. Those are the things that they are looking at, right? So they're not looking at if the stock market is down 2, 3, 5%. They're looking at, and this is their mandate, maximum employment and price stability. And they're both important, equal, because if you don't have price stability, then your economy is going to be in trouble, right? Without price stability, there's going to be a lot of pain. The economy is going to be in trouble. You need that price stability. That's why it's part of their mandate, and obviously maximum employment. So, and the market, in my opinion, right now, I don't think that what we're seeing, the repricing right now in valuations, is actually taking into account potential negative earnings or slowdown in the economy. It's really repricing for a higher risk-free rate, right? So if you think of a stock, what is a stock? It's priced based on future projections. It's not priced based on what it did in the past, but what people think it will earn in the future. But the earnings in the future, right? Because you have to wait. If you invest in a stock, then you're waiting for the stock or the company to generate those earnings sometime in the future. And if the interest rate goes higher, then the present value of those earnings are lower, right? That's why the stock market is going down. So even given the same earnings projections, even if you say, I think the market earnings are going to grow 5% per year or 10% per year, if the interest rates go up, those earnings in the future are worth less to you today when interest rates are high. Okay, so that's where I think right now the market is. I don't think it started to, because I'm using my calculator, my simple calculator. I don't think that the market right now is discounting negative earnings growth, or even margin compression. But let's keep this in mind. This is what they're looking at: maximum employment, price stability, right? That's where they're going to, and it's important to know because this is what's going to drive their economic policy, which will be important to stock prices, housing prices, everything, right? And this is kind of like this is a table, and we'll go through it. It's a good summary table of what they're looking at, and it's not like dots in the graph. This is just in table format. I'm going to make it bigger. Let's take a look at it. I'm going to make it bigger, and let's just see what, because they're indicating to us the metrics that they're looking at, which means these are the important metrics, what they're projecting, right, going into the future, and where are their targets. So over here, let's start with change in real GDP. So GDP, gross domestic product, obviously very important, because you want your GDP to grow, your productivity to go up. So if you don't have positive GDP, that's not good for your economy. That means you have negative productivity. You want your productivity to grow, because that's how your economy, without productivity, you don't have much of an economy, and there's no progress. So here is their median projection. So you could see year over year. This is their current one. So for 2022, they don't have a negative GDP, but very low growth, 0.2, of 1%. And how did that change? Well, you could see their June projection was 1.7. So you could see here how much their projection has changed as data comes in, right? And it's important to think of how your projection of even earnings or stock prices can change. And this is happening through models around the trading desks. So you could see here, how much these projections change as new data comes in. And a lot of these models are doing kind of the same thing with earnings projections, iPhone sales, or, consumption and so forth. But let's stay focused on here. So here, this is how they expect the GDP to grow. So you could see here, they think next year, GDP, we will see higher growth than this year, 2024 higher growth, 2025, and then their long run GDP, where they think we're going to be growing at 1.8% year over year.
Hey, Dee.
Right? Yeah.
Robert was asking, can you please repeat your comment on earnings growth and margin compression?
Right. So there are two ways to look at it. When you price a stock, right, you're buying a stock based on some future projection, right, that you think that it's going to earn and yield. Just like if you bought, like, say, a piece of real estate property, well, you're saying you're going to collect this much rent, and you think that rent might grow 5% per year, let's say, right? So then you say, okay, based on that, this is what I'm willing to pay for this piece of real estate, right? So kind of to simplify, think of it like that as a company. This is what I think they're going to earn, and this is what I think their earnings are going to grow year over year over year. So based on my projection, this is what I'm willing to pay today for that company. But it's relative to the risk-free rate. So you might be willing to pay, like, for example, if you think, oh, well, somebody's going to give me $10 in a year from now. Well, if you're generous and interest rates are zero, you'll say, okay, you know what? I'll lend you $10 today. You could give it back to me in a year, because I don't need to use it and interest rates are zero, right? But if interest rates are, let's say, 10%, well, you're like, well, wait a minute. Yeah, I'm generous. I'll lend it to you, but somebody's giving me risk-free 10%. So if you're giving me back $10 a year from now, I'm only willing to give you $9, right? And then you're going to give me back 10 at the end of. So you could see that the risk-free rate, even the same payout, if I could get, the higher the risk-free rate is, then the present value of that future payout is decreasing, right? As you increase interest rates. But let's say interest rates are going up. Well, now maybe your ability to pay that $10, that is riskier, right? Because you're like, well, wait a minute, I don't think you're going to be able to pay me back $10 because interest rates are higher, economy is going to slow down, and maybe you're going to lose your job or you're going to run into some financial. So all of a sudden, maybe you'll only be able to pay me back $9. So that's what when I'm talking about, declining in earnings, those interest rates, as the cost of capital goes up, that could weigh in on your ability to grow your earnings. And that part, I don't think, has yet been discounted in the market, right? So if you do that, the market would be much lower, in my opinion, than it is today. Does that make sense?
Yeah, that's super helpful, D.
Okay. So let's get back to the real GDP. So this is where they're saying, where their median projection, how we're going to grow, right? So you could see they think next year it's going to grow. The year after that, it's going to grow. Then in 2025, we're going to reach 1.8, which is where they think in the long run, that's a good GDP. And that's coming from different members of the Federal Reserve, and they're taking the middle one, right? So here's their central tendency. So they're giving you the range, right? So that's another important thing, because when we forecast stock price or volatility or whatever, you give it a range, right? So here's, in 2023, so far we saw the worst one was 0.5, best was 1.5, the median 1.2, right? So now you kind of have their projection of a worse than best case, right? And think of it as if your projection is a stock price, you might give a probability of an optimistic case or a pessimistic case. So here we're going through and saying, here's the median, and here's a range of their forecasts. For 2024, you could see on the low end 1.4, on the high end 2. And I don't know if that's actually taken in, I don't think that's taken in their worst case or their best case. I think what this tendency is, it's taking the median from different members and giving a distribution, okay? So that's what this is. And you can see here, this is their long run. That's the range. So that's their GDP, right? What else are they looking at? Unemployment rate. So here we are right now. Their projection for 2022, 3.8. Their previous projection was 3.7. So it's a little bit higher than their projection. Here's where they think the unemployment rate is for 2023, 4.4. So you see that their projection unemployment to go up, mostly probably due through their actions, right? Increase in interest rates. So they're looking at going from 3.8 to 4.4. Their previous projection was pretty optimistic, 3.9. They think unemployment will stay at 4.4 through 2023 to 2024. Then it'll start going back down, 4.3, and their long run is 4%. So you could see here's where their long run is, 4. So we're even below that right now. So that's why they think they have they have some cushion here to increase interest rates because the unemployment rate is below their target rate anyway, right? And here's like where their tolerance levels are. And on the high end, I see a 4.6% here in 2024. All right. And I'm gonna show you, is that optimistic 4.4? So they are taking up interest rates. If we go in a recession, you know, and they said it, and they did say that there's a possibility we do go to a recession, right? Which will also change these numbers. But look at 4.4, and this is why I think some people are saying they're going to create millions of, you know, job losses. This is the unemployment rate, you know, since 1950. And here, these gray areas, right? These gray areas are recessions. Okay. And here we are right here. So we're right here right now, you know, around 3.7, 3.8. So you could see here from historical level on the very low end, and it usually goes on the low end, and then we get a recession. So if you see these recessions, you know, we're seeing them pop above 5% each time. So everywhere there's a gray, you could see here, this was the housing bubble. We made it up to 10%. Here's the internet bubble. We made it up to 5.7%. And I think the internet bubble was not as bad as what we were seeing today, because the internet bubble, it did impact people who were invested in internet stocks and maybe the stock market. So those people were hurt, but it was more contained. So it wasn't as widespread through the economy as, like, say, the housing bubble, right? Where we really had a financial crisis. This internet bubble, I would say, is probably not as bad situation as we are right now. Okay. You know, because I think we have high valuations right now, as I said. So we made it up to 5.7%. I think that 4.4% may be optimistic. You know, maybe they'll pull it off, but that seems to me pretty optimistic, given that the world is taking out excess liquidity, right? It's not just America taking out, you're seeing it everywhere now. Everybody's seeing the inflation problems. They're all raising interest rates. That cost of capital is going up. So here's where people are, you know, worried that a 4.4 projection on an unemployment rate would be something that, you know, we haven't seen them, you know, that would probably be like a very optimistic scenario. You know, it would probably be for the records, you know, where they navigated our economy out of inflation, out of, you know, high valuations, all this, and just maintain a 4.4 unemployment rate. I think would be, based on this, you know, they would be, you know, hailed as geniuses, but we'll see. So that does seem to me optimistic, given the history. And, you know, some of them here's a projection as high as 5%, but they're keeping an eye on this, right? So here we go. That's one of their mandates: unemployment. PC inflation. So this is personal consumption. So it's different than the CPI, but so the CPI tends to run higher than the PCE, but they look at the PC as their preferable inflation metric. And here we see here they're projecting 5.4 for 2022. Previous was 5.2, but you could see how they think it's going to come down pretty quickly. So 2023, they think it's coming down to 2.8, 2024, 2.3. By 2025, it's going to hit their target rate 2%. So they're long-term target rates right here, you know, for GDP, unemployment, and the PCE, 2%. Core PCE, this will run lower because this is taking out those volatile fact components like energy, food prices, and so forth, if they take that out, you could see here 4.5. They think it's fallen to 3.1, 2.3, 2.1. All right. So these are important things to keep an eye out, because all these are going to impact where the Fed funds rate will be. And as we know, that will impact everything else, right? So Fed funds by the end of the year, 2022, they're looking at a 4.4%. So we still have a way to go, right? That's they're indicating to us this is where they think 4.4. And on the low end, we got a 4.1. So even on the low end, you know, we still have ways to go on that Fed funds rate.
So with that Fed fund rate, I mean, the 30-year mortgage could be well over 6%, right?
Yeah, it's very possible, right? Because, and that's kind of where we were, I think. Where did we get up to during the financial, when they had, before, you know, the Fed started raising interest rates? I think that's where we went up to. Well, we're above 6% now, right? Well,
yeah, you're right. It is.
We're already above 6%, so it could even go higher. But I believe that we're already above 6%. So 4.4%, they're indicating we're not done, right? So their models, and they're looking at models, you know, I wouldn't even be able to explain. They have like hundreds of PhDs. They're looking at all these numbers and surveys and, you know, trying to, but that's what they're telling us, that their model 4.4% on the Fed funds rate. Where are we now, Will? 3.25.
Yeah. So
you could see it's still a lot to go, and that's increased from their June projection of 3.4. So you can see there how much their projection changed just from June, right? With the numbers coming in. 2023, we might go even a little bit higher, 4.6. And 2024 is where they think they're going to start easing, 2025 easing, and their long term where they think is neutral is 2.5. So remember, 2.5 is neutral. That's where we were before yesterday. Right now, this is where, for the first time, the Fed started to be restricted. Right. So far, we've either had stimulative, easy policy, or neutral. Yesterday was the first day where the Fed said that, in their opinion, now they're on the lower end of where financial conditions are becoming restricted.
Hey, right? D, it's almost 9:30. I know we got a meeting right at 9:30.
Yeah,
we got to get to.
Go.
Could you just show Rob how you got to this chart again?
So this is on the FOMC. If you go to the Federal Reserve, right? If you go to the Federal Reserve Open Market Committee, they'll just go to the Federal Reserve website and you'll find it.
All right, awesome.
So, yeah.
Great job, D. Thank you, chameleons. You guys all have a great trading day. Thanks, D.